I appreciate you joining us today. Again, I'm Barry Page, and we're real excited to share this concept and strategy with you. And whether you've seen some of this stuff before or you're a seasoned veteran, I think you're going to get a lot out of today's webinar because it's going to be a little different. This is packed with information today, and it's not going to be a pitch fest. We have nothing to sell here today. We're just simply sharing education, and we want to share with you how infinite banking has worked in our lives. So stay tuned. We're going to get going. So first thing I just want to let you know is that this is not, we don't want to manage your money. This whole concept, this whole strategy is about putting you in control of your money. So that's what we're going to do today, is just share with you how it works. And we want to challenge you to be your best, and we want you to consider investing in yourself, because that's really what this is all about. If you get nothing out of today's webinar, what I want you to get is that you are worthy. You are the asset, and you are worth investing in. And you can retire, you can live the life of your dreams without government plans and without depending on the banks. So again, I want to welcome my co-host and guest today, Dr. Erik Nilssen and Jerry Wood. Say hello, guys. Make sure we can hear you okay.
Hey, guys.
Right.
Glad y'all are here.
Yeah, glad. Thank y'all for joining us. So I'm going to go ahead and get started. If you're ready to get started, let me know. Are you ready? Type a 1 or a yes in the chat box, please. Arizona. Welcome, Travis. Jorge, good to see you. All right. So let's get started then. I want you to know this whole webinar, Infinite Banking, is an exercise in imagination, reason, logic, and prophecy. That's right out of Nelson's book, Becoming Your Own Banker. And it's just a way to think differently. It's a whole paradigm shift at the way that we look at money. Nilssen said the whole idea is to recapture the interest that one is paying to banks and finance companies for the major items that we need during a lifetime, such as automobiles, major appliances, education, homes, investment opportunities, business equipment, etc. So why should you listen to us? Well, after a lot of hard knocks as financial advisors and just living life, we've discovered in about 50 years combined experience between me and Jerry, we've determined that traditional financial planning does not always work, and there is a better way. And we practice infinite banking in our lives, and we really love sharing it with others. So that's what we're going to do today, is just share our stories with you. Now, you may be wondering why you're here, and that's important because when you think about it, your why is everything. It could be your family, it could be your faith, it could be some other reason, but Simon Sinek said start with why. And so you have to ask yourself, why would you be willing to change your habits? Why would you be willing to swim upstream against the norm? And why do you think you have the discipline and commitment to stick to a banking plan like we're going to show you here for years? Because it does take time. It doesn't happen overnight. You might have a family. You might have children, grandchildren. You love your family and you love financial freedom. So that's what we're going to offer you today. And you might want to leave a legacy for your family and other causes that you might have. You might be a business owner, or you might have thought about starting a business. But we all know if you want to have a business, you have to have access to capital. And I think you're going to like what we have to share with you about this today. You might be fed up with the banks and just sick and tired of paying interest and fees and seeing that money being transferred away. You may have debt that you want to get rid of. But primarily, you probably want to just know the secrets that the banks know, and that's what we're going to show you. So with this infinite banking concept, you can literally revolutionize your financial picture and live the life you desire on your terms without bank rules. So in the next hour, you're going to learn more about banking and finance than probably 95% of the population out there knows. And it's not about interest rates. It's not even about the return on your investment. So we're going to share that with you here. And just understand that this concept and strategy is nothing get rich quick about it. It's no pie in the sky. There's no sales gimmick. There's no upsells. We're not going to sell you anything today. And it's not for everyone. Now, I just want to mention, too, that we're not techies, and we didn't really script any of this out. We hadn't rehearsed it a whole lot. We've just talked, and we did this a little earlier today. But we also have a storm going on here where I live, and the rain is coming down. So if we lose you, lose connection, we'll try to reconnect. Just hang with us. But just understand that we do have a huge storm going on down here on the Gulf Coast where we are. This process takes time, it takes discipline, and it does take commitment. It's all based on this book right here, Becoming Your Own Banker. If you don't mind, just in the chat window, could you tell me if you've read that book or not? Have you read Becoming Your Own Banker? Just say yes or no. Love to have your feedback on that. Nelson Nash wrote that book, and as many of you know, he just passed this last month. He was a mentor of mine. I met him about 15 years ago, and he literally changed my life. And I'm more excited than ever to share this concept with others. It was his legacy to teach others about this, and so now I feel it's my duty to share this with you, and I'm sure the other guys feel the same way. That's why they're here today. So we just want to give gratitude and respect to Nelson. So here's $1 million question I have for everybody. If what you thought to be true about money turned out not to be true, when would you want to know about it? Most people tell me sooner than later. And so this is your chance to exit from the norm. If you keep going straight towards tyranny, working with the banks and the government, or you can take the exit, and this is about the truth. So we're going to share the truth with you today about how this concept works and how you can use it in your lives. So you may have heard this standard advice: save money, get out of debt, invest for the long term, and diversify. Have you ever heard that? Well, investors who've been following this advice have lost tens of trillions of dollars in the stock market. That money's gone forever. That money will never return to them. It'll never work for them or their family again. And if it works so well, work hard, go to school, get a good job, why do you think so many people are struggling just to make ends meet, living day to day, paycheck to paycheck, in the most prosperous country in the world? And despite all the warnings, they still follow this advice. But it's not your fault. That's what we've been taught to do. From the schools, from the media, and from the financial institutions. Even the government is in on it. So why haven't you heard this before? Well, again, the banks and the financial institutions do a real good job at confusing things, and they don't want you to know. But it is time-tested and proven. Matter of fact, it's used by the largest corporations and banks in the world. They use this very same strategy to protect and minimize their risk. So let's take a look real quick at how people spend their money, and then I'm going to move on and turn it over to these other gentlemen. So this is the annual pattern of spending. If you've read Nelson's book, you know this is right out of the book. And the green lines indicate the amount that we spend for automobiles, housing, living, saving, and the red is the interest we pay. Now that includes fees, and over time, if you took that, well, I guess I left that other slide out. It's about 34% or 34 cents out of every dollar. Now think about that for a minute. 34 cents out of every dollar that we spend towards interest. Okay? 34 cents. Now how much does the average person save? Well, the most recent reports say that the average American is saving less than 5% of their income. So if they're spending 34 cents on interest and financing, and 5% or even 10%, or let's give them 15%. How in the world could you ever get ahead with that scenario? But yet, people keep doing it. So the very first principle that you must understand is that we finance everything that we buy. You either pay interest to someone else or you give up interest that you could have earned otherwise. Now, what do I mean by that? Well, the problem is that all this money goes to the financial institutions. We'll never see it again. And the interest portion of it is perpetual. It goes on and on and on. So it's the volume of interest. It's not the rate. And Jerry's going to expound on that a little bit further here in a minute. But here's a scenario, and everything's here on one screen, but you can think of the interest as the headwind, right? And let's just say you're in an airplane and you're going 300 miles per hour. Well, if you've got a headwind of 100 miles per hour, then your airspeed is 200, right? Now, in the same, if you've got a tailwind of 100 miles per hour, then that's going to speed you up to about 400 miles per hour. But look at that. That's twice as fast just by getting rid of the headwind and getting the tailwind. So that's what we want to teach you today, is how to get a tailwind instead of a headwind in your financial life. There's that other screen I was looking for. So taxes are another problem. I don't know if we'll have time to get into that, but just understand these are uncertain. And we've got some people out there, asking for Medicare for all and college for all. So banking is the most important business in the world. And let me just share with you a little bit about my story, and we'll move on. I've been in this business about 15 years, and I was fortunate enough right when I got into the business to meet Nelson Nash, really by accident. I had lunch with him and at a conference we were at. And I'd been in the business right at about a year at that time. And shortly after and I was already investing in life insurance. I actually had a good feeling about life insurance because I had read a lot of books on it many years ago that planted the seed for me. But I only knew good things about life insurance. So I was already funding a life insurance policy. I wasn't really doing banking, but I had accumulated some cash value. And I live on the Mississippi Gulf Coast, and that's where Hurricane Katrina hit 15 years ago. So as you see here, there's a lot of blue roofs. Well, I was heavily invested in real estate at that time. I had 12 properties. 10 of them were rented out at the time. And, some of them had more damage than others, but every one of them had roof damage. So if you just round numbers here, if you think 10 properties, $5,000 a roof, that was about $50,000 in roofs that I needed. Now, I had tenants in all those properties, and all those properties were cash flowing. So I had listened to all the financial gurus, one of them being Robert Kiyosaki, and I primarily invested for cash flow. So all the properties cash flowed, and they were cash flowing. I'm just going to round the numbers off for you, about $200 a month. And so that was about $2,000 a month positive cash flow after all of my expenses. Well, the hurricane isn't what hurt us. As a matter of fact, right after the hurricane, rents were strong because though we had to wait 30 to 60 days for insurance to pay the claim to get the roofs on, I was fortunate enough to be able to go to my insurance policies and borrow money to get roofs on these houses, and then we could wait on the insurance to come through. So we were able to get these roofs fixed within about a week or two, and the tenants were able to stay in the homes, and our rents continued. That wasn't the problem. The problem came later. Actually, it came about a year and then 3 years later. The first thing that happened was, most of you know that insurance went through the roof down here on the coast after the hurricane. So those houses that were cash flowing, the insurance, property and casualty insurance, in some cases tripled and quadrupled. So there went my cash flow. So now we're back a little bit less than break even. And then the government decided to get involved. So what did they do? Well, a lot of people have moved away from the coast after the hurricane, and they decided to raise property taxes to make up for the lost residents. Well, so property taxes go up about 30%. So there went all the cash flows on the houses. And I'd also listened to some other gurus that told me to put all your rental properties in an LLC. So we followed that advice, and we put them in LLCs and trust and all of this and that. And well, what do you think happened? We had to go back to the attorneys. We had to unbundle those things and change the contracts around. And anyway, it was just a huge fiasco. So that was my lesson with real estate. Now, I still love real estate, invest in real estate, but there's obviously disadvantages and advantages that you never hear about from the gurus. and things that we cannot control. That's the point. And the point is that we cannot control the markets. We cannot control the government and taxes. And we can't control things like insurance that we have no way of controlling. So fortunately, I had my policies to go to, and they saved me on many occasions. And I bought many policies since then. I now have 9 policies with my family. And so that's, in a nutshell, how I got started practicing banking. I now have loans on most of my policies, and I finance just about everything that I can, from taxes, my income taxes, to vehicles, to my business. So that's how it's worked for me. And I just want to turn it over now to my co-host and good friend, Jerry Wood. So Jerry, you're up next, buddy.
All right, get ready, guys. There's going to be a little bit of BS in this, I promise you, unless I pass out. I wrote a note while Barry was talking, and basically, hey, Barry, take that off till I get ready for it.
Okay, no problem.
I'm going to try to make this fast so you don't have to listen to a lot of hot air.
Please.
But Nilssen said, and I fully believe this, that your wealth has got to reside someplace. And there's, as many choices as you can imagine. It could be in real estate equity. It could be in a stock portfolio. It could be in a 401k, which is essentially the same thing as a stock portfolio. It could be in a bank. It could also be in life insurance. Recently, Dr. Nillsen and I had a conversation, and I told him that you need to think of this as just another account. And he has gotten this concept better than most, way better. And he said something that just really made an impression on me. He said, I never really thought of it that way. This money is not locked up in Fort Knox. It's just in an account called cash value. And I can tell you without any reservation, if you do not run your money, as much of it as you can figure out, if you do not run your money through life insurance first, it will never be as strong as it could have been. I met Nelson Nash in 1999, maybe 98. So I've known him a long, long time. We have done or had him do about 14 seminars. And the first one was in 99. And it was myself and another insurance agent in Pensacola. We paid his fee to come down and talk to our people. I had 6 people at that seminar. He had 12. All 6 of my people took action. And the majority of them are still taking action. They're still buying policies. As a matter of fact, I just wrote a policy on one of the people that was there, and it was insuring his mother. We've lost count. I think he's got 18 policies. So figured out from 1999 till today, this man has figured out how to have that much insurance. So what happened after the seminar? Well, all 6 of my people took action. As I just said, the other agent had 12 people there and not a one took any action. The common thread was that I had told my folks, if you do not read the book before the seminar, don't come because you won't understand what he's talking about. I had already read it twice before the seminar. None of the other agents, people took any action at all. Common thread, they didn't read the book. Why am I telling you this? I just last year read the book for the 60th time. And when I was getting ready to make a presentation today, I just couldn't stop reading past the information I was trying to find. So I'm fixing to make it 61, and I've never wasted my time yet. The last seminar we had was at Andrews Institute in Gulf Breeze, and here again, nobody read the book, so nobody took any action. Had a room full of people. Anyway, Barry asked me an interesting question after we had first met. Obviously I'm about a year older than baseball, and it's not the years that get you, it's the miles. And I put plenty of miles on my body, as Dr. Nillsen is aware. I think he told me I didn't have a single joint in my body that wasn't in trouble. But anyway, there's 2 reasons. In November of November of 09, I was taken down a deer stand. You probably won't believe this, but I know how high I was. I was 40 feet off the ground. I fell. And I thought at the time that I wouldn't even have time to make peace. But it turns out I didn't even lose consciousness, at least not then. Got my first helicopter ride, taken to a hospital by life flight. About 9 surgeries out, the guy that was cutting on my left ankle got fired. By the grace of God, Erik Nilssen and I got together. Since that time, Erik's had to do several operations on me. In the first 5 years after that fall, I had 18 surgeries that I can count for. Not all of them serious, but they still put me under. I developed MRSA, a nasty infection, which you really never get rid of. So between all the surgeries and the recoup, you know, I didn't have a whole lot of time to work. I don't know how most business owners work, but with my business or this business, it's like putting corn in the front of the hopper. You grind it up and you get cornmeal at the backside. I wasn't putting very much corn in the hopper. So I'm working because I have to. And the only reason I have not lost everything that I had worked 20 or 30 years for is because I had a boatload of cash values in my life insurance policies. So I'm trying to regroup what I once had. The second reason, I'm not I don't bang the church doors open every weekend, but I am a religious man. I do believe in God. And I felt like at the time that there was some reason that I didn't bite the bullet that day. That good man upstairs had left me here for a reason. I don't care how corny this sounds, this is the truth. I think it was because I know how to help people with this, and I'm under some sort of obligation to share this knowledge. So 2 reasons: I need the money, and I enjoy helping people. That's my mission in life. Dr. Nillsen and I, when we first met, he made the mistake of asking me what I did for a living, right, Erik?
Oh yeah, very bad.
So we're in I think we met in an examination room, and basically I said something to the effect that I didn't need to ask him what he was doing with his money. I already knew. He was doing everything that every other lemming he knew was doing. He was trying to max out his 401k. He was sending extra payment in on his mortgage to pay his house off quicker. He had a bunch of term insurance. Did I leave anything out, Erik?
Oh, you pretty much nailed it. It was insulting.
He told me he felt like I was on candid camera and I was undressing him in front of the camera. I wasn't trying to be smart ass. That's what people are doing because we have been programmed to do it. Now, all of us, every last one of us is polluted financially. If you listen to TV, you can't see a single episode where they're not talking about your 401k did this today or your 401k did that tomorrow. You know, after a while, you get to believing if you don't have a 401k, you've been left behind. So you said something, Barry, about the interest rates, not everything. Would you show the 3.6?
No, you ready?
Yes. Start out with 3.6.
Okay.
I once had a client say, why would I pay the insurance company 4.4 when I can finance a car for 2.9? And basically at the time, I didn't know the answer to that. I do now. The interest that you're paying to the bank or the finance company is compound interest. The interest that the insurance company charges on borrowed funds is simple interest. So here's an example of 3.6% financing on a $50,000 car over a 5-year period. You'll see that I have circled the first year interest payment, $1,620.87. You'll see that the total monthly payments the first year, almost 11 grand. That is not 3.6. The volume is what gets you. It's 14.8%. Now, if you make the total payments, if you end up paying that car off, which most people, according to automobile dealers, 95% of the trade-ins are still financed. They are not paid for. That makes this situation even worse. But if you had paid that car note, interest and principal, basically what you've done is transferred $54,631.80 to a financial institution. You will never see that money again. Kind of odd, but the average 401k balance today is somewhere around $100,000. Folks, if you just finance 2 cars like all your friends are doing, you would recapture more money than the average 401k balance in 2 cars. Now, if you take the total interest by volume, add up all those circle figures and divide them by the full cost of the principal interest, you will find out that it doesn't equate to 3.6. It's actually 8.5%. So we hear about a car dealer down the street, 2.6, Barry. So we think if we can get 2.6% financing, we're a point better. Man, that's going to really make a difference. But you can see the figures for yourself, folks. First year volume, you pay 11% in interest. If you pay it till it's completed and you've paid it off, you'll end up paying more than twice what you think your interest rate is. 6.25, not 2.6. The average person who trades in a vehicle, it's not paid for. So what they're doing is they're probably getting out here to about the 3rd year and they're buying another car. Sometimes they're even upside down in the one they have. And if they keep that up long enough, I did some math. I don't have it ready to show you, but I can tell you, if you traded every 3 years under that scenario that you're seeing right now, you'd end up paying in perpetuity 8.7% interest by volume. That's why GMAC, when it was around, was the biggest profit maker of General Motors. Ford Motor Credit's the same thing. There was a time in America when if you didn't have a Sears card, you weren't really being treated fairly. Why is that? Because Sears and Roebuck made more money financing purchases than they did building washing machines and selling them. That ought to give you just a little bit of reason to want to know more about what it is we're discussing here today. One other thing is most of the people I've worked with over the years, their main concern is, what's my monthly payment? Well, why do they think that way? Because they're not looking under the hood of the car they're financing. Does that make sense to everybody? I certainly hope it does. Now, after I had talked with Dr. Nillsen, and I had told him that I knew what he was doing, he started doing the infinite banking concept. He didn't catch it all at first, but let me tell you, you are fixing to be in for a treat because of all the people I've worked with over these years, and I have been in this business about, I don't even want to tell you, a long time. One other thing, let me digress. You know, a lot of people are leasing cars, and what leasing leads to is a perpetual car payment forever. Money that's going out of your checkbook and you will never see it again. It's like having a big leak in your gas tank. You can fill it up all you want, but it's going to keep leaking anyway. This concept, these concepts can stop the leaks, folks. And the more money you keep in your control, the wealthier you will be. I would appreciate it if you would all write this down because there's nothing truer. You can create more wealth by recapturing debt than you will ever create by buying more assets, period. Okay? Now, Erik Nilssen, when I first started doing business with him, I wrote him 2 whole life policies. I did 2 for a reason. And I thought, I'm going to write him a bunch of term that's convertible so he'll never have to take another exam. And I didn't know if we'd ever convert all that insurance. But in less than, I don't know, I think it's about 7 years now, it's all gone. It's all converted, every last penny of it. I've never met anybody that was more caring, that had his patient's best interest at heart, that made me feel like I would follow this man through the gates of hell if I was under anesthesia. And we have become more than just an advisor and a client. Erik's a friend, and you are in for a real treat. I can tell you this, he is the foot and ankle guru in this part of the world, maybe in the entire nation. But beside that, he knows how to run a medical practice. So with that, Erik, take it over, bud.
All right. You're too kind, Jerry. You guys see that okay? Can you guys see that?
Yeah, see and hear you fine, Erik. Thank you, Jerry. Everything looks good.
Okay, good. So, yeah, thank you all for tuning in tonight. And I really, really appreciate the opportunity to share with you guys, my experience with infinite banking. As you'll find, hopefully in the next 20 minutes, it has completely changed my life. Let's see here. Technical issue. Barry, I can't advance my slide.
Click on the screen there, Erik. Sometimes. Okay,
there we go.
Yeah.
Sorry about that.
Yeah, no worries.
So everybody has a story, okay? And, my story is my daily job, like Jerry said, is I'm an orthopedic surgeon. That's what I do for a living. That's how I pay my bills. But my business is medical entrepreneurship. And that's really where my passion is. And, the infinite banking concept has allowed me to capitalize on various business opportunities in the healthcare profession, in which I'll share those with you. So my life goal, and Jerry talked about his mission, my life goal was really to change my family, my fortune, and my future, okay? And through the infinite banking concept, in addition to, it's allowed me to basically create a system and a strategy when combined together has created a strategic financial system that's the most powerful in the world, in my opinion, that has allowed me to reach my goal. I certainly have changed my family's future, my fortune, and my personal future. So why is that? Why has that done that? So I will tell you that, as a medical doctor, I've spent over half of my life being educated. So I've attained the 27th grade, 4 years of college, 4 years of medical school, 5 years of residency, 2 years of fellowship, on and on. However, in that formal education, I've had no classes, no instruction, no mentorship on what to do with your money once you make your money. No investing courses, banking, nothing. So I humbly tell you that I'm in the top 1% of wage earners, but again, I've got no formal education on this. So systemically, there's a systemic failure, at least in my world, and I would bet there's systemic failures in other specialties as well. So I went on a mission. I said, I got to go find the answer to this. What do I need to do? So again, in my world, I call this the healthcare pie. And at the center of healthcare is the doctor, okay? There are no prescription drugs unless the physician writes an order. There's no MRIs, X-rays, CTs unless the physician writes the order. There's no real estate hospitals or doctor's offices that are being built unless the physicians work there. So at the core of all this, physicians are writing all this. And to me, all this money is being generated off the doctor. And so one day I said, well, man, I actually would like to get a piece of that pie. So how can I attain a piece of these pies? So like Jerry said, I started my practice in 2009. I call it the old path strategy. Really, it's pitiful. Work your ass off, make a lot of money, put it in the bank, and my investment account is my retirement account, was my 401k, because that's what I was told to do. I had a few opportunities pop in, some startup companies. Hey, this is a sure thing. I threw some money at it. And on a side note, I've lost all those investments. And I said, well, go down to your bank and hire your financial planner. And that to me was concerning. And Barry talked about that. Losing control. I just felt, how can I make all this money and just hand it off to somebody I barely know and hope that that money's at the end of the road when I want to retire? So Jerry came in the picture. Like I said, I mean, unfortunately, to Jerry's demise, it was my gain. He challenged me mentally. He challenged me with a paradigm shift. Change the way you think, Erik. And he challenged me, gave me a book. It took a while. And so I took his challenge. And it was a bit insulting. He did it in a good way. And so I took it personal and sought out, some information. So what's the best financial product, I asked myself. So I went on Google, started looking at stuff, and here's all the products out there, or at least some. And at the time, how am I supposed to pick a product if I can't tell you how it works? So I thought, well, that's kind of strange. So I learned about the product, and I said, well, I asked another question. And this is a shout out to Tiger Woods from last weekend for winning the Masters. But, someone asked me this, Erik, would you like Tiger's shoes, his hat, his shirt, or would you like his clubs? Or would you rather have his swing? And to me, that was a shift in my thought process. And so I stopped at that time hoping for a financial product would give me a high rate of return, which Jerry touched on. And instead, my focus was on the process. It was based on knowledge, strategy, and a sound system. And that's what I sought. And so through this dividend paying whole life policies, I developed a system and a strategy. And there's 3 disciplines of strategy. Number 1 is acumen. And what that really means is insight. So I engrossed in reading the book multiple times, seeking information on the internet. And so I became very knowledgeable on this concept. Allocation, I spent my time, energy, effort, and now all my money goes into this system, and I put an action plan. So now, over the course of years, 7 years, I've taken the infinite banking concepts and I've dumped them into these pieces of the pie. And now I own 2 medical offices, one which the hospital rents from me, which is comical. Number 2, I own an X-ray, a CT, and an MRI. I own my own physical therapy, and I'm investor in a surgery center, and I have my own bank and insurance company. So now the pie is my own pie. In 7 years, it's my pie. So I'm going to share that with you, how I got there. So infinite banking strategy is, I'm a huge fan of this because it's safe and secure, and you do not lose any principal, unlike the risk you take in a 401k, number 1. 2, taxes, okay? I do not like paying taxes. What's so nice about this is I'm paying my premium with post-tax dollars, and the cash value is growing in the policy tax-free, and you pull it out tax-free through a loan. I'm reducing my payments to other people and institutions like banks, unlike 401ks. I've got access to my money at any time, and it gives me asset protection. Nobody can touch it, including a creditor. And also transferring wealth to others. I'm not transferring any of these fees and interest rates, which we just talked about, to banks. And I'm leveraging the equity and the cash value to make purchases, which I'm going to show you how I do that. And this is a monster. Take anything away from this, you've got to go read about it and fully understand, basically the gasoline or the engine that drives this car. It's compound interest. You've got to understand it. And then also the fact that I'm now in control. I'm the bank and I'm also the borrower. So don't lose principal. What impact does that have? So basically any loss on an investment, including a 401k, can have a profound effect on your wealth. Here's the Dow Jones from 2009 back to 1929. 20-year period is the longest period there wasn't a hit. There was a hit at the end of 2018. So what impact does that have? This is a nice example. Just a simple, on the left is a savings vehicle like a life insurance policy we're talking about, compounding at 5%. In the middle is a money market account, rate of return at 8%. Over 10 years, nothing happens, and as you'd expect, the 8% does better, $5,000 more. What happens if there's a hit? So year 1, a 20% hit in the market. That's it. 20% isn't much. And at the end of the day, over 10 years, compounded interest does better by $300 with no risk. What happens if it happens at year 5? The numbers don't lie. Whether it's year 1 or year 5, it's the same result. How about the last year, year 10? Numbers are the same. So in the day is you've got a 0% chance of losing any principal with infinite banking, unlike a 401k. This is my 401k. I started in 2009, so I was very fortunate to start this at a good time. You know, those who retired took it in the shorts. I started my practice. I'm bearing them some fruit out of this. So this is mine. At the end of 2018, right before Christmas, it was like, Merry Christmas, here you go. Trump pissed off the Chinese or who, something. If you guys can tell me, please put on your survey. But I took a $36,000 hit for no reason. I don't know why. My wife's took a hit too, and collectively, our 9-year gain took a 33% hit basically in a day, okay? And if you average this out, I'll come back to the slide. My after-tax, so my return on investment over 9 years is about $10,000, which really isn't too bad. But after taxes, because money coming out is going to be taxed, as we talked today, would be $6,000 a year after tax profit. We'll come back to this. So again, it's growing tax-free, and you take it out tax-free through a loan. This is how it works. Pay my premium with post-tax dollars. It's growing in the policy tax-free at a compounded rate. I take a loan. There's no tax on the loan. I get the money in hand, and I have two options. I can finance a personal expense or finance a business expense. Most of mine are business expenses, and I'll show you examples. Barry showed this real quick, and I think this is important. You know, we're at the lowest tax rate in 80 years, you know, irrespective of your political views. This chart, our tax rates are going to go up. It's just my opinion. And the character on the screen, like if he had it his way, that's where they're heading. And so when the tax rates go up, and I'm, say, 20 years down the road, it'll have zero bearing on me pulling money out of my policies because that money's not taxed. Unlike my 401k, I don't know what that tax rate could be. Could it be 15, 20, or 90? I don't know, but I don't want to take that chance. So reduce payments to institutions. This is a cool little example. 3-year investment at $10,000 initial investment. Average rate of return is 8%. Pretty steady. 12.5 after 3 years. This is a money market account. Here's my mutual fund fee of 2% added into this. Same numbers. Average 8%. You take into account the 2% fund fee, and now it goes down to 4%. That's a pretty big hit. And here's my 401k, real numbers. My plan fee right there in red, $534. So these fees are real, and they have a huge impact, and they skew the numbers for you, so you really don't know. And like Jerry said, look at the volume of money. Don't pay attention to the rate. So this is the same policy Jerry's talking about. I started 2 of these in 2012. You can see it in red. So my policies, my 2 policies, we overfunded them. So you see in the upper left, $50,000 a year for 5 years. So I call this concept seeding. I'm sowing seeds of financial greatness. I'm planting my seeds, and I'm overfunding for the first 4 to 5 years. And in the end, it's going to produce an aged harvest for me. So my base premium is $13,300. You'll see that at year 6. So this is an important concept of how these policies are initially funded. And at 5 years, I've paid a total of $250, and my cash value is $235. And we'll go into the nuances of this in just a sec. So here, back to my business. So this is an in-office MRI. This lives in my office. Cost of this in-office MRI was $235,000. All my partners and colleagues, oh man, we can't afford that. And I said, sure you can. So I said, I'll take one of these. So I took this machine. I called my accountant and I said, hey, I'm buying this machine end of the tax year. I claimed a 179 deduction, so I wrote the entire cost of the machine off in year 1. So I'm really only paying $145. Okay. I called Jerry and said, Jerry, I'm buying an MRI machine. Call your friends at the insurance company. Tell them I need some money. How much do you need? I said, I need $225,000. He said, no problem. 5 to 7 days later, a check is sent to me. There's no credit checks. There's no application. There's nothing. I own the policy. So the money comes in the mail. I deposit it, pay for my MRI. I set up a promissory note back to myself, and I'm the bank and the borrower. I set the terms. I set the rate. I set everything. And then I write off the interest rate on the loan back to Ohio National. So now I'm taking a liability, an expense, and I'm leveraging it to an income producing asset in my business. You can apply this to anything you do for a living. So now my money is working in two spots. It's compounding in the policy, and it's producing an asset that is making me money in my business. And I challenge you to find that in another financial vehicle to do that. Same thing, this is an in-office CT scan. I bought it for $200,000, same thing, take a deduction, write it all off. I'm really paying $120. Call Jerry, same process. It's an income producing asset, and I'm leveraging it as a liability. No brainer. So you can do this, like Jerry said, with cars, boats, personal expenses, or any business expense. So I run all my businesses through this. I run my mortgage through my business, my two medical offices, everything I can, I run it through my business. So you ask yourself, well, why would you do it this way? Well, let's go back to my policy. 2012, we started $250,000 over 5 years, $235 at the end of 5. That's the cash value. Told you my premium is $13.3 at year 6, and it trends all the way down consistently. If you notice, in year 6, my base premium, this is where it gets good. My base premium is $13,300, and my cash value from year 5 to 6 went from $235 to $261. Cash value increased $26,000. Real numbers, that's a 97% return on my investment in 1 year. You'll find that out somewhere in the market. Year 7, it trends higher because of the compound interest. Same premium, $13.3, cash value increases 105%. Okay? Let's move on down the road. Now 20 years into this, I'll be 58 years old. I'm 45 now. 20 years down, I'm 58. I pay my base premium of $13.3. My cash value is increased by 50 grand in 1 year. That's just the piddly 276% return on my money. Okay? And now let's go down to year 37 years down the road. If I'm still kicking, I'll be 75 years old. Okay, my parents are older than that and they're still alive, so hopefully this works out for me. So 75 years old, my base premium, you notice I put an asterisk, it's down to $12.9. It's about $300 less, $350 less. Why is that? Well, there's a special little rider in these things called waiver of premium. And waiver of premium is a powerful little thing. Just ask Mr. Jerry Wood here on the screen. Say, for example, I'm going to work tomorrow morning and someone T-bones me and I can't really work. Well, guess what happens? My premium gets paid for me. Okay? That's what happened to Jerry when he fell out of the tree. It saved his ass, like he said. And so at that point, I'm no longer working. So waiver of premium goes away. I'm 66. Okay, that's why it went down. But a very powerful thing to have. I called my financial advisor from a few years ago and asked him, hey, is there a waiver of premium in the 401k? He didn't know what I was talking about. So anyway, so
you couldn't do it by law anyway.
Yeah.
By law,
so year 37, back to that, I'm 75, and so for $12,900, you ask a 72-year-old for 13 grand, would you like to increase, your cash value $118,000 in a year? That's an 818% return. So that's unbelievable. So that's how powerful these are, because you can tell it's compounding interest. I placed the seeds earlier, I overfunded, and now, I'm using the cash values now to finance my business, but down the road, this is my retirement. So back to that 401k thing I had, it was 9 years after taxes. It was a $6,000 return. That's what I've averaged in 9 years. When the market's high, you compare that piddly $6,000 risk after taxes to the numbers I just showed you. And if anyone out there thinks the 401k is better, just call me. I got some good psychiatrists in your area you need to go speak to, okay? These numbers are extremely powerful. So the loan is really a lien against the policy. The insurance company is giving you the money. It's not coming out of your account, so it's a lien, okay? Money is working in two places, like I talked about, and like Jerry and Barry talked about, I'm recapturing the money on the MRI. It's not going away to the bank or anybody else. It's going back to me. So this is my son's policy. I got 3 kids. So forget the overseeding and don't pay attention to the numbers. I mean, you know, it's all relative to what you can afford. It's infinite banking. So you can make your premium whatever is comfortable for your financial situation. So don't get carried away in that. We didn't overfund this right away. So this is my 5-year-old, lucky as hell. He's got a dad like me. But this guy's 8 now. The old man's paying $4,500 a year for him. And if you look at this, every year his cash value is growing. But when he turns 21, his base premium goes to $1,400. It stays like that forever. So $1,400 is what it comes down to. When he's 30 years old, he pays $1,400. He's got $180,000 plus cash value in his policy. And his policy increases by 10 grand after a $1,400 investment. When he's 50, it increases $43,000. And when he's 70, just off this simple little policy, because it's been brewing for so long and the compound's kicking in, he's 70, he puts in $1,400 and it grows $84,000 in 1 year. It's incredible. Cash value of 1.6. Okay. At any time he goes to college, when he goes to college at 18, what do you think I'm going to do? I'm going to pull money out of his policy. I'm going to pay his tuition out of this. That's what I'm going to do and pay it back. I'm going to run his tuition through the policy. So to appreciate compounding interest, 2 investors, forget Chris, but Susan and Bill. Susan puts $5 grand in. It compounds for basically 10 years, age 25 to 35, and she stops. She's the blue line. Bill invests for 30 years. He starts when she stops. And Susan kills Bill on the investment because of the compound interest. Get it in early and let that sucker grow. Again, those who understand compound interest earn it, and those who don't, pay it. Albert Einstein, pretty smart guy. This down here in the right-hand corner is that old penny thing. You know, I say, hey, man, compound interest, I can give you $3 million, or would you take a penny compounded over 30 days? I was like, I'll take $3 million. You would have lost out. So the penny compounding every day for 30 days, I mean, after 23 days, it's still 41,000. Say, would you still take that? You'd say, no, I want the $3 million. Look what happens in the last 5-6 days. That's the power of compounding interest. Other chart here, simple interest is linear. That's the blue line. It's flat. Compound interest mimics simple interest in the beginning. And over time, that spike starts to occur. And then in the last 10 years, you see it's almost vertical. Very, very powerful. You have to understand that. I'm not sure if Barry talked about this, but again, the debtor and the saver. I mean, I go to the bank, borrow my money for my machines. I pay the bank back. That money's gone. I never see it again. Or I'm a good saver. I save all the money. I pay cash for the machine. Money's gone. Either way, the net is zero. There's a better way. Okay? This is the debtor. Zero is your baseline. Here's your saver. I save my money over the course of 5 years, pay it off, and back down to zero. This is the wealth creator. This is what using your policies does. I got cash value, which is the dotted line. I take a loan. I start paying my loan back, and the whole time I'm paying my loan back, that dotted line is compounding and compounding. So I don't end up back to zero. I'm ahead. So this is really the crux of all this. Extremely powerful.
Uninterrupted compounding.
Yeah. So why do it? I'm getting close here to the end. And this is, to me, this is awesome. I mean, this is crazy. So why do this? Cash value life insurance, one of the most important assets of a bank. So if the banks are doing it, why wouldn't you want to do it? Right? They even have their own name. It's called bank-owned life insurance. I take it one step further. Majority of the banks keep their tier one capital held up in life insurance, more so than fixed assets. So you can find this all on Google. I mean, there's a reason why they're doing this. They take life insurance policies, on their employees, and billions and billions of dollars in life insurance. It's impressive. So I do the same thing. It just reemphasizes what I'm doing. I'm doing the right thing. And this is my favorite as well. So I'm a college football fan. Jim Harbaugh for Michigan Wolverines and Dabo Swinney, first two. Harbaugh was the first. Harbaugh received, he negotiated a life insurance loan in his contract with the school. So his financial advisor knows what he's doing. He's an infinite banker for somebody. They know. It's more powerful and financially to his advantage. Rather than take a $9 million a year salary, he's taking like $6 million bucks, and the rest he's making the university put it in a premium. Why is that, you ask? Well, it's pretty obvious. And Dabo Swinney did the same thing in last year as well. So pretty soon you'll see this going on and on. So anyway, I think that's, to me, very powerful. So infinite, you're constantly learning and creating. There's no end to it, like Jerry said and Barry said. It has had a profound impact on my life. It has changed my life. It has changed, why not do this? The banks are doing it. The coaches are doing it. Executives are doing it. Jack Welch for GE didn't take a salary. He took life insurance premiums. They paid for that. Just go look it up on Google. There's a reason for it. So go learn about it. Take the road less traveled, and I think it'll change your life. So I appreciate you guys' time.
Wow. Thank you, Erik. That was awesome. Thank you so much.
How are we doing for time?
We're about to questions, but go ahead. You got something to say?
Well, I forgot. I didn't forget. I just want to get to the better man of the three. This is a book that I've read several times here lately called Smart Retirement.
Okay.
It's got some really good knowledge and information in it. In fact, some of it I knew and some of it I didn't. But what really blew me away is the first person he wanted to recognize in the acknowledgement section was Nelson Nash. And the next guy he recognized was Barry Dyke. Barry Dyke's an IBC, Infinite Banking Concept guy. Wrote the book called Pirates of Manhattan. Great read. It'll make you wonder why you're doing what you're doing. Now, there's a couple of sentences in here that say it all. His idea is Nelson's book should be mandatory reading starting in the 8th grade and required each and every year thereafter. With his infinite banking concept, you never really graduate. You just get better as time goes on. I am still learning stuff or thinking up ways to use that cash, because that's why they call it infinite. It's only limited by what you can come up with. There is no limit to how you can use this money to recapture things that are just getting away from you every day of your life. And I talked to somebody recently who was going through a course, don't want to slander anybody, but I asked them if at any time in taking that course, had they ever mentioned the word recapture? And you know what the answer was? No, because it never entered their mind. They're on the lemming trail. They're following the lemmings in front of them. They're going to end up jumping off the North Sea and committing mass suicide. We could go on and on and on and on about why we have been led down the path we're on. I do appreciate the opportunity you listen to us talk, especially me. And we'll open it up for any questions, I guess, Barry. Isn't that the next step?
Yes. So if you have any questions, just type them in the chat box there, and we can actually give you the mic as well.
Hey, Barry?
Yeah,
Barry, sure. Jorge had a question earlier, which I'll read it out loud. You guys want to tackle it, but it's one we get a lot. It says, my biggest problem is with the index universal life promoters, that they always say you can do the same with universal life with better results. The question is, what's the best argument to face them?
You want to take that, or you want us to?
Yeah, so I mean, I'll start it, and you guys chime in. And this comes up a lot. And again, for my strategy, it's safe and secure. It's about risk. The problem with index universal life, you can do the same, but the problem is, you are going to take a hit. The market is going to take a hit, and you are at risk for losing principal and capital. That's not going to be there. Whereas dividend paying whole life, zero risk. in terms of losing capital. That's my argument to them. You might be able to make a little more, but over the course, like I said, there's a market crash, longest is 20 years. I mean, it's going to take a hit, and I don't want to be on the receiving end of that. So you guys chime in.
Right.
Well, you know, we don't know what the market's going to do, but I'll guarantee you one thing, it will lose money again somewhere down the road, and you will never get back what you lose in a year. Tell them what your advisor told you about your 401k, Erik.
Yeah, he said, oh yeah, he goes, well, yeah, he goes, don't worry. I says, it'll always come back. You just got to hang in there.
How far do you want me to hang? I've never written an index universal life, and I don't think I'll ever will. There's too many moving parts. There are too many ways for the insurance company to get out of the obligation. It goes back to, what do you want? Do you want the swing or do you want the clubs? And most of the people that are buying that product don't understand it. You said it best, Erik. If you don't understand, I can't explain it to somebody. How in the world am I going to be able to service it?
Right.
Too many moving parts for my blood. And we're always looking for a better kitchen knife, but the one that we've had that's sharp in the drawer cuts just as well. I understand whole life. I know how it works. It's a lot more solid. That's my opinion. I hope that helps you, Jorge.
And I'll just a couple things on it. My experience is every time I've seen one of those policies that's more than 10 years old, they're on their way down. And as a matter of fact, just recently I have an attorney client that's what he does, is sue insurance companies. And he's a client of mine, though. I'm on his good side. But he brought me a client of his policy. And he said, can you look at this? And it was a UL policy. The guy was, he was a doctor, and he was in his 70s. And the thing is, there's no guarantees with those policies. The risk is back on the insured. And the financial institutions, the life insurance companies are financial institutions. They want to come out with new products every year. Whole life insurance, what we're talking about, is tried and true. It's been around for centuries. It's guaranteed to get better every year. It has to get better every year according to the MEC laws that were passed in the 80s. So the thing with the UL, again, back to this one particular client, or this doctor, he wanted to know what he could do. And I said, well, there's not a whole lot you can do. His premium went, now check this out. He was putting a lot of money in here. I guess he thought at the time when he first got it 30 years ago, he was putting about $3,000 a month, $36,000 a year. Do you know what the premium went to on that policy now that he's in his 70s?
I have no idea, but I know it's high.
$30,000 a month. Right? Just to keep it in force. And so the cash value that it had built up, they always look good in the illustrations, but now the mortality is eating into it. As he gets older, it's basically a term policy with a cash value built into it. And they did that to compete against whole life. So anyway, my argument is, well, hey, you know, if you want something that you take the risk, then that's fine. I personally don't sell those policies. I never have. I don't really have any issue arguing against them, because I just, you know, it's just a new thing that the financial institutions want to come out with every year. And we work with stuff that's tried and true, and that's what this is. So these policies, just to kind of reiterate, you know, what's the difference, but they're uncorrelated to the stock market. So the company performance, the stock market performance is uncorrelated. They're guaranteed, like I just said, to increase every single year. And that's as long as you pay the premiums according to the provisions in the policy. They provide protections and savings and tax-free benefits. So, and like Erik said, you don't have to qualify for the loan. There's nothing better than not having to fill out a loan application when you want money. You just pick up the phone, you call Jerry or myself, or you can even call the company direct and ask for a loan. Now, there's reasons why you might not want to call the company direct, but that's how easy it is. It doesn't take a lot of paperwork. You certainly don't have to qualify for it. So you're in control, and these policies can be made generational.
Well, there's one other thing I thought of. I mean, I'm not always quick on my feet. I'm a little slow, but I'm not stupid. These IULs, Index Universal Life Policies, the premiums are not actuarially calculated. You know how good actuaries are at what they do?
Good.
They're extremely good.
Yeah.
And those policies, I believe, have early or surrender charges. So the access to the money is severely restricted early on, the ones I've seen. I want all that money to be accessible to Erik so he doesn't have to say, well, in 10 years, I can access all my money. That is something I thought of while you were talking, is surrender surrender charges early on. You'll get a cash value and then you'll get an actual value that you can use. And I think if you look at a whole life policy, it'll be better in the early years.
Yeah, I
Awesome.
just would say that, it's, singles and doubles, man. Don't go for a grand slam.
Yeah. Okay.
Yeah.
That's a good idea.
Well, if we don't have any more questions, I'll kind of close it out with this. So we basically today covered how insanely profitable that banking can be. Erik demonstrated, Dr. Nillsen, how he uses it in his medical practice. We also showed you how you can reduce the wealth transfers and actually have a more positive impact on the return of your money just by reducing your transfers to interest and fees. We also showed you how you can use a business. That's what Dr. Nillsen showed you, how he actually went out and purchased equipment for his business, and how you can purchase any major purchases, whether it be cars, your kids' education, whatever you want through your policies. And really the truth about the 401k, which we didn't really get into that too much, but taxes are uncertain. And so with any qualified plan, that's a government qualified retirement plan, meaning an IRA, a SEP, 401k, even a Roth is dictated by the government, right? So they can change the rules. And if you like uncertainty, well, that's what you have with a qualified plan. So here's the rules of infinite banking. And this came directly from Nillsen. And the first one is you have to think long range, right? You can't think, life insurance companies are some of the only companies on earth that are thinking 100 years down the road. That's why he just talked about actuaries, Jerry did. Those guys, they're pretty accurate because they're dealing with 1 million lives and they're dealing 100 years down the road. They know mortality. So we have to think long range. We can't just think about tomorrow. Most businesses are thinking about next month, next quarter, and unfortunately most Americans, a lot of them live paycheck to paycheck. You have to capitalize your system. Nillsen says, don't be afraid to capitalize. Dr. Nillsen wasn't afraid to put money into his policy, and then once you see how well that it does, you're going to want to put more. Most of my clients, and I'm sure Jerry would say the same thing, they come back and they get more policies, just like I have, just like Jerry has, and just like Erik has. You get more policies. So don't be afraid to capitalize. And you have to use the policies, borrow and repay whenever you have a major purchase, just like you would a bank, and in return, that policy will grow more for you. But you have to discipline yourself to do this, and you have to do it over and over. And then one that I've added in here, and what I feel like our duty is to do, is just to teach this to other people. So teach your family about it. There's a reason that we want you to read that book, is because you'll have it to go back to refer to, and it's really going to help you understand this. Like Jerry said, I think that's the most I've heard of anybody. He said he's read it 60 times. I've read it about 15 now, and I've seen Nillsen live probably about 15 times, as well as listen to his CDs probably at least a dozen times as well. So every time you hear that, you'll learn something new, and then you can take that book and you can pass it on to your children or the people you care about. So those are the basic rules for IBC. And if you would do us a favor, at the end of this, you're going to have the opportunity to fill out a little survey and just tell us how we did. And if you'd like to meet with us, you can. And that's really the challenge that we have for you, and that's to take action. First, you need to read and reread that book, Becoming Your Own Banker. And if you've read that, you might want to read The Case for IBC as well. That was Nelson's last book he co-authored just before he passed. And invest in yourself. You want to save and purchase things of value. Just like Dr. Nillsen bought those MRI and CAT scan machines in his business. They're going to make him more money. Again, you are the asset, so invest in yourself, invest in things that are going to increase in value, and you'll have returns that are literally infinite. So be your best, set goals, and strive for excellence. And if you want to get started with your own bank, it's real simple. You just need to schedule a review with us, and you need to start capitalizing your system, and you need to practice IBC. So you can do that with a survey at the end. And this is what we're going to do for you. You're going to get personal consultations and coaching to set up your plan. We don't charge a fee for any of this. It takes a lot of time for us to do this, but there's no cost, no charges, no fees to drain your plan. There's no cost or access to contact us via phone, email, or web conference like we're doing now. And you'll have access to our team of advisors from setting up your plan. It's not just us. We've got other people that help us, from attorneys to accountants, that can help us with this. There's no cost for copies, mailing, documentations that we use in our meetings. And right now, there's no cost for service work to get your loans. Again, it's better to go through us than to go through the company, but just to administer your plan. And then we do annual reviews every year just to make sure your policy is set up and doing what you want it to do, and go over any changes that may have happened in your life. So that's how you can get started. We always get questions, how do you get started? And we appreciate you joining us today. And guys, if y'all have anything else to add, you can do so. But I do thank you for your time. Thank you, Dr. Nillsen. Thank you, Jerry. And thank all of you for attending.
Thanks, guys.
Great.
Enjoy.
Yeah,
Thank
so
y'all.
please take the survey and let us know how we did. We appreciate your feedback.
All right, guys, I'll see you. Erik?
Thanks, guys. See you, man.
Thank you. Y'all take care.